everybody's doing well. Last week we talked about profit actions and we talked about 0-day actions. And what we found is that there are some that work, but overall, on 0-day profit actions, it's more for your mental health than necessarily your P&L. That sometimes it's just a good kind of thing to take money off the table. It helps us, even if the test didn't show it. Today, we're going to look at one test in a couple different ways to show where it actually does affect the P&L. And just as a couple caveats, first off, options involve risks and are not suitable for all investors. This is backward-looking, not forward-looking. If you have any questions about options, please consult your financial advisor. We are not financial advisors. This is simply for entertainment purposes. Are you not entertained, as Maximus says? So, with that one caveat, the second caveat is today is just one test. It's just one test, and it's doing a couple different iterations. So, one test, 4 tests total, I think. All the same setup, only dealing with profit actions and how that affects the P&L. So with that being said, I'm going to share my screen. Here we go. Can you guys see it? Anybody see my screen? Cool. Thank you. All right. So with that being said, let's dig in. Let's start with the loser first. So we have here a straddle. This is a long straddle without profit actions. It is a 15-day straddle. And all we're doing with a straddle is we're buying the 50 delta put, buying the 50 delta call. We're opening the trade at 10 a.m. every day, and we're allocating 100% of our portfolio. Don't ever do this. This is foolishness. But it's fun to talk about it. And the only exit criteria, win, lose, or draw, is we're going to exit the trade 7 days to expiration. And then I have some opening and closing fees and things like that. So far so good. You guys see it? All right. So let's look at the trade log real quick. You did actually have some winners in this. You did win. Strangely enough, I wouldn't have guessed it was this big, but it kind of makes sense from a probability standpoint. You won 51% of the time, so you did win, but your losers are just brutal. And just for the fun of education and entertainment, why would a long straddle, long vega, negative theta, get killed in this environment this year? Please type now if you have any thoughts about that. Why would this trade not work as is? I'm going to let people talk a little bit. I'm enjoying this cigar today. The weather's good. So if you see long periods of silence, especially me looking off in the distance, it's just a lot of reflection. But I also will give the time to type. Why does this trade suck? Why is this bad? Why is this not? Heavy volatility and negative gex. Now, wouldn't that theoretically, Dirty Funk, mean that a straddle should work? Right? Just that alone. You're correct. That's why you would win 50%, I think, this year. But why would it not? Yeah, that's one reason. Yeah, you're spending a lot on premium, so these are very, very expensive to put on. You know, $9,300. You know, 10,000. Look at that baby right there. It's expensive, and so it's expensive, and you are paying. That's exactly right. That's perfect. You're paying rent in perpetuity, right? And what does that mean? Your theta is just bleeding. You're just bleeding theta. all day, every day. Every day there's not any movement for an hour, you just are losing money, right? And because this year's been crazy, you'll have days where it's like, hey, April 18th, put this on at 43.91, took it off for a good, what was that, 291, 100, yeah, 200 points lower. We did great, right? We're geniuses. So I chose a test to show profit actions that would be interesting for this year, because theoretically this would be a good trade, right? Like this would be the year to trade this type of strategy. But you have to do it smartly. And this is the number one takeaway I think that we should perhaps look at. My opinion, please prove me wrong, is that with debit spreads that are long gamma, with long gamma trades, profit actions make a lot more sense and have a much bigger impact than trades that are perhaps credit spreads. And that's my premise. Let's keep looking at the test and maybe we can talk about that. So that's our baseline, a losing test. Now let's go back and look at the same test taken with profit actions. So, second test, exact same test, 15 days to expiration, 50 delta put, 50 delta call, open it at 10 every day, allocate 100%. That's stupid, whatever. We're just pretending. The only difference, again, we exit the trade, win or lose or draw, 7 days to expiration. The only difference is at 10% of profit target, we're going to close 80%. So if you look here in the profit target here, at 10% profit target, we're going to close 80% of what we have on, and we're going to then adjust our stop loss to 5%. So we're rolling our stop loss up. And what are we doing in effect with that? We're closing the majority of this position, and we're keeping 20% on with a very, very tight stop loss. What's happening in that? Like, why, what are we doing? Try to think from like an options Greek perspective. Any takers? Well, with long gamma, negative theta, every day's hurting us. We got a small amount of profit. We took it off, and now we have a much smaller set, but it's gone in our favor, right? So now we've adjusted the stop loss, basically, and what we've done is we've taken theta off the table, we've taken gamma off the table, we've just reduced the size, and we've locked in profit at this point, right? We've locked in profit, especially closing 80%. That's the only difference. Now think about this. Exiting 7 days is basically a full loser. I mean, you're losing 89% of your value. Simply with one roll, taking 10% off, or sorry, at 10% of profit, closing 80% of your trades, and setting the stop loss to 5%, you suddenly are winning 81.7% of the time, almost a 30% increase in win rate. You still have a large drawdown, but less large than before. You now have positive MAR, positive CAGR, positive P&L, which is perhaps the most important metric. And you do pretty well with this trade. That's super interesting to me, right? I mean, that's crazy to have such a bad trade, to change one thing about it. And the thing that you're changing about it isn't deltas. It isn't, it isn't your gammas. It's not your days to expiration. The only thing you're changing is how much you take off at a profit target. You're taking profit at this point. Pretty crazy. Let's keep going. So that's at 10%. At 10%, we do that. Next up, Let's look at 15%. So this one's a little bit interesting, and this is why I wanted to put this in here. Same exact trade. This time at 5% profit, we're going to close 5% and set the stop loss to 5%. And at 15%, we're going to close 15% and set the stop loss to 5%. And then we're going to exit the trade with 7 days to expiration. Now, this doesn't do as well. Why do you think this doesn't do as well? Different profit targets versus just waiting till 10% and taking 80%. Why do you think that doesn't do as well? Any takers? My guess would be, oh, sorry, scroll back up. My guess would be that we're not taking enough off. We're not locking in enough profit. Because with straddles, every day counts. For those of you who are newer to options, side note, this is largely how market makers would trade in the 80s. Not quite this. I mean, they would use some futures and some stocks to hedge it, but basically, they were constantly trying to dynamically hedge and be delta neutral in their trade. And what would that look like? So in a long straddle, you're gaining deltas because you're long gamma, or you're getting short deltas if you want to be short deltas, as it goes down. And so how do they lock in profit? They lock in profit by getting delta neutral. So if they were short shares, short deltas, they would buy back the shares equivalent to get to neutral. If they were long, they would sell off. If you've ever followed a service like Spot Gamma, even Squeeze Metrics, some other places like that are looking at the gamma of the market, this is largely what market makers are doing. Bro, that's right. I mean, I think it's largely 5% seems pretty good, but I think it might be a case that you're just not closing enough, right? So let's do this just to test it. 5% profit target, let's close 50. And at 15%, let's close the other 50 and just see what this does. So not quite as good. But what's interesting is the win rate is good again, right? Pretty interesting. So before I forget, if you don't want this test, but I'm going to give it to you, take your medicine. Go back to that. 10% action. One more. Let's now go back to the final one. And I'm going to go ahead and share that. Okay. Same test. 50 delta, 50 delta. At the profit target, we're going to do 10%. We're going to close 80%. But instead of setting the stop loss to 5%, we're going to give it a little bit more room to breathe. So we're going to set the stop loss to 10%. What's interesting is win rate goes down on that. 42% max drawdown, but the P&L is very, very good for that, for letting it breathe a little bit. And look at the trade log. You can kind of see how that works. I always like to go back to the last week just to see. So you did pretty good the last couple of days. Obviously, been a lot of movement the last week. Got hurt Wednesday, September 28th, you know, uh, but you had 29 of them on, so what are you going to do? Part of life. But overall, it does pretty well. So what's the takeaway? What's the takeaway for that as you look at profit auctions? Again, this is kind of just, I think I sent that already. What what's the what's the tell us of it? Well, in general, my theory, like I said, was I think long gamma trades are old school in the sense of like market makers. So you want to be locking in profit whenever you can get a move, right? In general, you want to be positioned enough to where you have enough of them on where you can leave runners on, but you can keep lock in profit as you go, right? You don't have to. It's not a one on, one off. You take some on, it goes in your favor. Take some off. If it doesn't do anything, take all of them off. But I think profit targets work really well for that type of trade. Um, have any of you guys traded in that way? Like when you're trading options, do you take profit? Do you scale out? And if so, what was your mechanism for knowing when to do that before? I see one of the founders typing. About to drop knowledge. Okay, yeah, so take the third rule or half rule. To make it a free trade rule. Smart. That is smart. Um, yeah, a lot of people will do thirds, half, try to make it a free trade. I'll do butterflies a lot of times. Yeah. Uh, when you want to go straight to the pub or the bar to show people what you just did, that's an exit criterion. Um, a lot of times with butterflies, I'll trade butterflies and I'll try to put enough on to where I can scale out to where eventually it's a free trade. So you have a free kind of lotto, stuff like that. Um, but so that's long gamma trades, right? That's not all log gamma, but let's say that's it's trades where movement benefits you. So you're scaling out. What does why do you think my statement, this is a fun little debate, is my statement of short premium trades, profit actions don't matter as much? Is that true or false? Again, it's an opinion, so it's my opinion, so it doesn't matter at all. It's not the law. I'd be interested to know. Do you guys agree with that premise? I see Vixen orange. Could you make this work with short premium trades? And if so, how would we do it? As you've tested, have you seen short premium trades that work better with profit taking? Oh, yeah, that makes sense. Thanks, Shara. Smart. Yep. Obviously, a long straddle, very Vega heavy. Vega gets crushed. Strategy not going to work real well. Profit taking for 0 day. Yep, you can use profit targets for that. What are some other ways that you guys, if you've tested using the profit targets or if you've thought about it, what are some of the strategies that you think would be interesting to test profit target?